Life in America is entering a dangerous phase, and you're not ready. Right now, not next year, not after the election, not after the next rate cut right now. The financial ground under your feet is shifting faster than most people realize. Over 60% of Americans are living paycheck to paycheck. Credit card debt has blown past $1.3 trillion, and delinquencies are rising fastest among people with good credit. The exact group that's supposed to be doing everything right. Real wages, once you adjust for cumulative inflation since 2020, are still down double digits for millions of households, while the cost of necessities, housing, insurance, food, healthcare has locked in at permanently higher levels. At the same time, layoffs are quietly spreading across white-collar sectors, savings rates are collapsing back toward pre-crisis lows, and more people than ever are relying on debt just to maintain basic life functions. This is not a recession headline. This is a structural squeeze, the kind that doesn't explode overnight but grinds people down until one shock triggers something much bigger. And if you're telling yourself this doesn't apply to you because you're still getting by, that's exactly how dangerous phases begin. Right now, you might feel like you're just a little stretched, like things are tight but manageable, like maybe once rates fall, or once you get that raise, or once the tax refund hits, you'll finally breathe again. But here's what the data is quietly screaming. Americans are not just stretched, they're structurally overextended. Credit card balances have surged past $1.3 trillion, the highest level ever recorded. The average APR on those cards? Hovering around 22 to 24%, which means if you're carrying $10,000, you're paying nearly $2,000 a year just in interest, and that's if you don't add another swipe. Delinquencies are climbing fastest among people who used to be considered safe borrowers, and that's the part no one wants to admit. When people with solid credit histories start missing payments, that's not irresponsibility, that's systemic pressure. And you feel it every time you open your banking app and see that the minimum payment barely dents the balance. It creates that quiet psychological shift. What's the point? I'm already buried. That mindset is spreading. Buy now, pay later loans are being stacked on top of credit cards, stacked on top of auto loans that now average over $700 a month, stacked on rent that in many cities has risen more than 30% since 2020. This isn't about avocado toast. It's about survival math no longer working. The dangerous phase isn't that people are spending recklessly, it's that millions are financing groceries, utilities, and insurance premiums. When everyday life requires leverage, you are no longer in a stable system. You're in a fragile one. And fragile systems don't break gradually, they snap when confidence goes. So the question isn't whether you know someone drowning in debt. The real question is this: if one unexpected bill hits your household this month, how close are you to joining them? The middle class is quietly losing ground. And side hustles are the smoke signal. You've probably noticed something subtle but telling. Almost everyone you know has a second source of income now. Not because they're entrepreneurial, not because they're bored, because one paycheck no longer covers reality. Recent labor data shows that multiple job holders are near multi-decade highs, and surveys suggest that more than 70% of working Americans rely on some form of side income, whether that's gig work, online selling, freelance projects, or overtime stacking. But here's the uncomfortable truth. The average side hustle brings in only a few $100s a month. That's not wealth building, that's bill patching. Meanwhile, real wages adjusted for cumulative inflation since 2020 have struggled to keep pace with housing, insurance, medical costs, and food. Grocery prices alone are still roughly 20 to 25% higher than pre-pandemic levels, and insurance premiums in some states have jumped double digits year over year. So what happens? You compensate. You drive rideshare at night. You flip items online. You monetize hobbies. You tell yourself it's temporary. But when temporary stretches into years, that's a structural shift. Historically, when a broad middle class needs multiple income streams just to maintain baseline living standards, that signals economic stress beneath the headline numbers. GDP might look fine. Stock indexes might hit new highs. But the lived experience tells a different story. You feel it when raises feel symbolic instead of meaningful. You feel it when your savings rate drops not because you're irresponsible, but because there's nothing left after fixed costs. The dangerous phase isn't high unemployment, it's quiet underemployment masked by hustle culture. When survival is rebranded as ambition, people stop questioning the system. So let me ask you directly, are you building wealth with that second income stream? Or are you just running faster to stay in the same place? Asset prices are floating, but access is collapsing. At the same time, households are straining. Asset markets are behaving like everything is fine. Stock indexes near highs. Home prices in many regions still elevated. Luxury spending resilient at the top. And that contrast between financial market strength and everyday financial fragility is one of the clearest signs that we are in a dangerous phase. Housing affordability, by most measures, is near multi-decade lows. Mortgage rates that doubled from pandemic-era levels combined with price appreciation have pushed the typical monthly payment for a median home up by 50% or more compared to 2021. Only a fraction of households now qualify under traditional debt-to-income standards without stretching. So what does that mean? It means ownership. The cornerstone of middle-class wealth is slowly becoming inaccessible to a large portion of the population. Meanwhile, rents remain elevated. Auto insurance costs have surged in many states by 15 to 25% year over year, and healthcare premiums continue climbing. Yet asset holders benefit from elevated valuations, while non-owners face rising entry barriers. That's what economists call a K-shaped environment. But here's what it really feels like. If you already have assets, you're relatively insulated. If you don't, the ladder is being pulled up. And when access collapses while prices remain high, frustration builds. Historically, periods where asset inflation outpaces wage growth for extended periods create social tension, political shifts, and economic resets. This isn't about envy, it's about math. When fewer people can afford to participate in wealth-building systems, long-term stability erodes. So as you watch markets rally and headlines celebrate resilience, ask yourself something simple. Are you participating in this upside, or are you financing it through higher costs and heavier debt? Because that gap, that widening distance, is where dangerous phases begin. The safety nets are thinning, and most people don't even realize it. What makes this phase especially dangerous isn't just the debt, or the rising costs, or the side hustles. It's the quiet erosion of the buffers that used to protect people when things went wrong. Look at the savings data. A growing percentage of households report they would struggle to cover a $1,000 emergency expense without borrowing. Emergency fund balances that were temporarily boosted during stimulus years have largely been drawn down. At the same time, the cost of the very things that hit during emergencies, car repairs, medical bills, home insurance deductibles, has climbed aggressively. Auto repair costs alone have risen well over 20% in just a few years, and health insurance deductibles continue creeping higher even when monthly premiums already feel suffocating. So when something breaks, it doesn't just inconvenience you, it destabilizes you. And here's where it gets even more fragile. Credit access tightens when defaults rise. Banks pull back. Underwriting standards get stricter. That means the same system people leaned on to survive inflation suddenly becomes harder to tap into. Meanwhile, retirement contributions are being paused, 401k loans are rising, and early withdrawals quietly increase because people need liquidity now. That is not long-term planning, that is short-term triage. Historically, when households begin cannibalizing their future to survive the present, it signals late-cycle stress. You don't feel it in a dramatic crash at first. You feel it in postponed dental work, in delayed car maintenance, in cutting prescriptions in half, in choosing minimum payments over principal reduction. It's subtle, but it compounds. And once enough people are operating without a cushion, even a modest economic shock, a mild recession, a wave of layoffs, a regional housing downturn can cascade quickly. The dangerous phase isn't when people panic. It's when they're one inconvenience away from panic. So I'll ask you this. If your income paused for 3 months, is your life stable, or does it immediately tip into crisis? There's another layer to this that doesn't show up in spreadsheets, but might be the most important of all: the mental shift. You can see it everywhere. The normalization of "put it on the card." The casual attitude toward five-figure consumer debt. The influencer culture that glamorizes lifestyle before stability. The quiet resentment toward saving because it feels pointless when asset prices feel out of reach. When people begin to believe that disciplined financial behavior doesn't materially improve their trajectory, that's when behavior changes. Consumer sentiment surveys have shown deep pessimism about long-term financial prospects, particularly among younger demographics. Many no longer believe they'll achieve milestones that previous generations considered standard homeownership, stable retirement, upward mobility. And when belief in upward mobility erodes, spending patterns often shift toward present gratification. Why sacrifice today if tomorrow feels unattainable? Historically, that psychological pivot has marked transitional periods in economies. In the late 1960s and 1970s, confidence deterioration preceded prolonged inflationary cycles and policy upheaval. In the 2000s, belief in permanently rising housing prices fueled reckless leverage. Today, it's a blend of both, inflated asset markets on one side and eroding optimism on the other. That's combustible, because economies run on confidence as much as capital. If consumers lose faith in stability, they either over-leverage chasing returns or shut down spending abruptly. Both outcomes strain the system. The dangerous phase isn't just economic, it's behavioral. When enough people internally decide, the rules don't work for me anymore, they stop playing by them. And once collective psychology turns defensive or reckless, policymakers are often reacting, not leading. So let me leave you with something uncomfortable. Are you still planning long-term because you believe the system will reward patience? Or are you quietly operating from a place of survival and short-term thinking? That answer tells you exactly where we are in the cycle. The job market looks stable, but it's hollowing out beneath the surface. On paper, everything looks fine. The unemployment rate isn't screaming crisis. Headlines talk about resilience. Markets price in soft landings. But if you zoom in, not at the headline number, but at the composition, you start to see something unsettling. Full-time roles in certain sectors have quietly slowed, while part-time positions, contract work, and temporary placements carry more of the weight. Layoff announcements continue across white-collar industries, particularly in tech, finance, and media, not always in catastrophic waves, but in steady, grinding cuts. At the same time, long-term unemployment people out of work for months has crept higher in certain brackets. And here's what's really shocking. Job openings don't always translate into actual hires. There's a growing gap between postings and placements. Companies are cautious. They're exploring talent pools. They're optimizing cost structures. Translation? They're hesitant to commit. Meanwhile, productivity expectations have surged. Workers are doing more with fewer colleagues. Burnout is climbing. Healthcare claims tied to stress and mental strain are increasing. So while you might technically have a job, the margin for error feels razor thin. And if you do lose it, the average duration to secure comparable employment has stretched in many sectors. Severance doesn't last long when rent, insurance, and groceries are inflated. That's why credit card balances spike after layoffs. That's why 401k hardship withdrawals rise. The job market isn't collapsing, it's thinning. And thinning labor markets can flip quickly if demand slows even modestly. Historically, employment deterioration lags economic stress. It's often the last domino to fall. But once hiring freezes solidify and cost-cutting spreads, the shift can accelerate. The dangerous phase isn't when unemployment is already high. It's when everyone assumes it won't be. So let me ask you directly, if your employer had to cut 10% of staff tomorrow, are you certain you're untouchable, or does even that question make you uncomfortable? The cost structure of American life has permanently reset higher. Here's the part most people still haven't fully processed. Prices are not going back, not meaningfully, not across the board. Even if inflation slows, even if rate cuts come, even if the headlines celebrate stabilization, the baseline cost of living has structurally shifted upward. Think about it. Groceries that jumped 20 to 30% over a few years rarely fall back to old levels. They stabilize at the new plateau. Rent increases compound year after year. Property taxes adjust upward with valuations. Insurance premiums, especially auto and home, have surged in many states due to claims, climate risk, and rebuilding costs. In some regions, homeowners are seeing 30%, 40%, even 50% increases over a few renewal cycles. Healthcare costs continue their relentless climb. College tuition remains elevated. Childcare rivals mortgage payments in major cities. This isn't cyclical inflation anymore, it's embedded cost elevation. And when fixed expenses lock in at higher levels, household flexibility disappears. That's why savings rates compress. That's why discretionary spending falls. That's why stress rises even when income technically increases. Because income growth rarely matches the step change in fixed costs. Historically, when a nation's core living expenses reset higher relative to wages, it produces long-term strain, not a dramatic crash, but a grinding squeeze. The middle class feels perpetually behind. Younger generations delay milestones. Older generations postpone retirement. And policymakers can't easily reverse it without either deflation, which brings its own risks, or aggressive income growth that's difficult to engineer. This is the dangerous phase. Not hyperinflation, not collapse, but structural compression. A society where more effort yields less margin. And once that becomes normalized, expectations shift downward. People adjust to less security, less ownership, less upward mobility. So the real question isn't whether prices are high. It's whether you've accepted that this is the new floor and what that means for your future if incomes don't dramatically outpace it. Trust in institutions is eroding. And that's when instability accelerates. One of the most dangerous signals in any society isn't inflation, unemployment, or even debt. It's the loss of trust. And right now, trust is bleeding out across nearly every major American institution at the same time. Confidence in government, media, financial institutions, healthcare systems, and even corporations has been steadily declining, especially among working-age adults. And this matters far more than people realize. Modern economies don't run purely on cash flows, they run on belief. Belief that money will hold value. Belief that contracts will be honored. Belief that the rules apply evenly. Once that belief erodes, behavior changes fast. People stop saving in traditional ways. They stop trusting official narratives. They start looking for exits, alternative assets, alternative systems, alternative explanations. You can see this in the explosive interest in hard assets, digital currencies, off-grid living, and parallel economies. You can see it in the way people increasingly question official inflation numbers because their lived experience doesn't match the data. You can see it when people say, "I don't care what the report says, I know I'm worse off." Historically, this is a critical inflection point. In the 1970s, collapsing trust in monetary management fueled inflation psychology. In the early 2000s, trust in financial engineering masked systemic risk until it snapped. Today, the erosion is broader and deeper. When people no longer believe the system is designed for them, or even functional, they disengage or rebel quietly through their choices. They hoard, they speculate, they withdraw participation. And once trust breaks, it is extremely difficult to restore without a reset event. That's why this phase is so dangerous. You don't see chaos yet, you see skepticism. And skepticism is the precursor to withdrawal. So ask yourself honestly, when you hear official reassurances about the economy, do you feel calmer? Or do you instinctively brace for impact? The pressure is converging, and history says, this is the most volatile moment. What makes this moment especially unsettling isn't any single problem, it's the convergence of all of them at once. High debt, elevated costs, thinning job security, shrinking buffers, psychological fatigue, institutional distrust. Historically, societies can survive one or two of these pressures in isolation. What they struggle to survive is when they overlap. That's when volatility spikes. That's when policy mistakes become more likely. That's when social cohesion weakens. And that's when sudden shifts, economic, political, or financial, become possible. History shows that late cycle phases often feel deceptively calm right before acceleration. The 1930s didn't begin with collapse, they began with denial. The 1970s didn't start with stagflation, they started with confidence that inflation was temporary. Even the 2008 crisis followed years of apparent stability. The warning signs were there, but they were fragmented. Today, the signs are no longer fragmented, they're stacking. And when pressures stack, systems don't gradually adapt. They reprice, they reset, they break and reform. This doesn't mean catastrophe is guaranteed tomorrow. It means the margin for error is gone. Small shocks now carry outsized consequences. A policy misstep, a credit event, a geopolitical escalation, a sharp downturn in consumer spending. Any one of these could act as a catalyst. That's why this phase is dangerous, not because collapse is inevitable, but because outcomes become nonlinear, and nonlinear systems don't respond the way people expect. So here's the uncomfortable truth. Preparedness now isn't about panic, it's about awareness. Because when pressure converges like this, history shows that the people who fare best aren't the ones who trusted the narrative, they're the ones who quietly adjusted before the narrative changed. At the very top of all of this sits a decision that no one is openly discussing in plain language. The system cannot continue exactly as it is without choosing who absorbs the pain. When debt levels across households, corporations, and government simultaneously expand while growth slows and costs remain elevated, something eventually gives. The federal debt has moved into territory that would have been considered unthinkable just 2 decades ago, and interest payments alone now consume a massive and growing share of government revenue. That limits flexibility. You cannot indefinitely fund deficits at high interest rates without consequences. So the options narrow. Either spending is cut, which slows the economy and risks unemployment spikes, or taxes increase, which compresses households further. Or inflation is tolerated at higher levels to erode the real value of debt, which quietly taxes savers and wage earners. Or financial repression is implemented through policy tools that keep rates artificially managed while purchasing power declines more subtly over time. None of those paths are painless. Historically, when governments face this kind of constraint, they prioritize system stability over individual comfort. That means the burden is distributed in ways that are often gradual but powerful. Persistent inflation that outpaces wage growth, asset repricing that locks out new entrants, currency debasement that pushes people toward alternative stores of value, or policy shifts that redefine retirement, benefits, and taxation. This is not dramatic collapse, it is structural transformation. And transformation phases are the most volatile because they alter incentives. If inflation remains structurally above target, cash loses appeal. If taxation rises, disposable income compresses further. If markets reprice downward, paper wealth evaporates quickly. The dangerous reality is that policymakers are navigating between growth, stability, and solvency, and they cannot perfectly satisfy all three. So something must adjust, and when it does, it will not ask for permission. It will simply change the environment you operate in. That's why this phase demands clarity, not fear clarity. Because when systems are forced to choose, the people who suffer most are the ones assuming the choice will never have to be made. If you made it this far, then you already feel it. You feel the pressure when you check your bank account. You feel it when groceries cost more, but the bags feel lighter. You feel it when your insurance renewal hits and it's up another 20%. You feel it when you realize one emergency could wipe out months, maybe years of effort. This isn't about panic, it's about awareness. Because dangerous phases in history don't announce themselves with sirens. They creep in quietly. They normalize struggle. They convince you that stress is just adulting. And then one day, the shift is obvious, but by then, positioning matters. The people who get hurt the most in transitions are the ones who assume nothing fundamental can change. But systems change, monetary orders change, job markets change, asset prices reprice, rules get rewritten. And when they do, the only question that matters is this: did you see it coming, or were you caught reacting? I'm not here to scare you. I'm here to tell you that ignoring the signals is more dangerous than confronting them. Because the numbers are flashing yellow right now: debt, affordability, trust, savings, job stability, and when enough yellow lights blink at the same time, history shows red isn't far behind. So don't dismiss this as just another cycle. Ask yourself hard questions. Strengthen your position. Reduce fragility. Build margin. Because if this phase accelerates, and it very well could, preparation won't look dramatic. It will look disciplined. And discipline is boring until it saves you. If you're seeing the same signals I am, drop your thoughts below. What are you noticing in your own life? What feels different this time? Because whether people admit it or not, something is shifting.